Hey everyone, and welcome to This Explainer. If you're a small business owner looking to grow, you've absolutely realized by now that you need capital. But here's the thing. Viewing capital merely as money or just cash in the bank, that is honestly the biggest mistake a first-time entrepreneur can make. Today, we're going to unpack the essential differences between two of the most critical tools in your financial tool belt, working capital and term loans. By the time we wrap this up, you'll know exactly which tool to reach for and, perhaps even more importantly, which one you absolutely need to avoid when funding your business. So think about this for a second. Seriously, ask yourself, if a bank literally handed you $100,000 today, exactly how would you spend it? Would you use it to make payroll next week? Or would you use it to buy a massive new piece of manufacturing equipment? The catch here, and what's really fascinating, is that how you plan to spend that money entirely dictates how you should borrow it. As we'll see, using the wrong type of financing for your specific needs isn't just, inefficient, it can actually trigger a full-blown financial crisis within your company. Okay, here is our roadmap for today. We'll start with why capital is structure, not just money. Then we'll dive into working capital, which is the short game, followed by term loans, the long game. After that, we'll talk about thinking like a lender, look at the dangers of mismatching those tools, and finally wrap up with choosing the right tool. Let's jump right in. Section 1. Capital is structure, not money. Capital is absolutely not interchangeable. We really need to establish a foundational truth right out of the gate here. A dollar raised through a short-term credit line is fundamentally different from a dollar raised through a 10-year loan. It arrives with a highly specific structure that determines your risk, your repayment timeline, and your operational obligations. Debt introduces discipline, sure, but it also imposes strict time limits. You aren't just borrowing money, you're borrowing a specific set of rules that your business must now live by. The golden rule is this. You must match short-term operational gaps with short-term debt and long-term asset growth with long-term debt. So if you need liquidity to cover a temporary gap in cash flow, say you're just waiting for a client to pay a big invoice, you need working capital. But if you're expanding your facility or, acquiring another business, you're playing the long game. That requires a term loan. Mixing these two up is exactly where first-time entrepreneurs so often stumble. Moving on to Section 2, working capital, the short game. Bridging the gap in your business cycle. Working capital is designed purely to keep things steady between your invoices. Let me be clear, it is not investment capital. It's that critical safety net, ensuring your lights stay on, your suppliers get paid, and your employees actually receive their paychecks, even when your revenue timing doesn't perfectly line up with your expenses. Imagine you're a retailer prepping for the holidays. You typically see a massive spike in inventory costs in the late summer and fall, right? Because you have to buy the goods months before the actual holiday revenue hits your bank account in December. A working capital loan bridges this exact gap. It provides a quick, short-term cash injection to buy that inventory. Then, once the holiday sales rush comes in, you convert that inventory into cash, and boom, you pay off the short-term loan. So how do you actually get this working capital? Well, one really common method is called an advised line of credit. An advised line is essentially a revocable commitment by a lender to advance you funds up to a specific limit. Usually it's reviewed annually. The crucial word here is revocable. It means the bank retains a whole lot of control. If your financial situation gets a bit shaky, the lender can just terminate the facility or simply refuse to advance you any more funds, depending on state law and the exact legal precedents written into your agreement. Now, compare that to a revolving line of credit, and you'll see a massive structural difference. With an advised line, like we just said, the lender has the power to revoke access. But a revolving line of credit gives the lender much less control. Why? Because there's a firm embedded guarantee, a literal firm commitment from the bank to make advances within your prescribed limits for a stated period of time. Because of this solid guarantee, revolving lines usually require you to pay a fee, but in exchange, they offer you, the entrepreneur, so much more certainty and peace of mind. Let's switch gears. Section 3, term loans, the long game, funding your permanent growth. Term loans are structured for fixed, long-term investments that pay off over years, not months. You borrow a fixed amount, you pay it back over a set schedule, and your costs stay completely predictable. You're basically trading the rapid flexibility of a short-term line of credit for the stability and lower interest rates of a long-term commitment. For instance, if you're buying heavy manufacturing machinery to build your own production facility, a term loan is exactly what you need. That machinery is going to generate value for your business over the next, say, 7 to 10 years. Therefore, a multi-year loan gives you a predictable, fixed schedule you can easily budget around. It perfectly matches the lifespan of the asset. Actually, government-backed programs like SBA 7A or 504 loans are frequently used for exactly this purpose because they offer these great extended repayment periods. But as you might guess, long-term money comes with strings attached. To protect themselves over these multi-year periods, lenders use things called covenants. These are strict rules detailed in your formal loan agreement. Affirmative covenants dictate what your business absolutely must do, things like maintaining adequate insurance or ensuring a baseline of financial stability. On the flip side, negative covenants dictate what you cannot do. This means you can't go selling off specific assets without permission or let your debt-to-equity ratio fall below a certain metric. And listen, violating these covenants is a big deal. It can cause the lender to accelerate the debt, which means the entire loan suddenly becomes due all at once. That's a catastrophic event that can literally wipe out a small business overnight.
Section 4. Thinking like a lender. Pulling back the underwriting curtain.
To truly empower yourself as an entrepreneur, you have to understand exactly how the lender verifies your loan's health behind closed doors. They definitely don't just look at your personal credit score. For short-term working capital, lenders obsess over your balance sheet. They're looking closely at your current inventory and your accounts receivable, mainly because the repayment source is the rapid conversion of those specific assets into cash. But for term loans, the focus shifts entirely. They look at your income statement right alongside the balance sheet. A term loan is repaid through your excess cash flow over years, so the lender needs to see a proven track record of long-term profitability and true business viability. All right, Section 5. The danger of mismatching, using a hammer to drive a screw. So what happens if you use the wrong tool? As a first-time entrepreneur, it is incredibly tempting to just grab fast cash when it's offered. But using short-term working capital to fund long-term assets creates immense, suffocating pressure on your daily operations. Just look at this domino effect. Step 1. You buy heavy equipment using a short-term line of credit just because it was approved in 24 hours. Step 2. Because it's short-term, the lender requires high daily or weekly payments, which rapidly drains your operational cash reserves. Step 3, now you have no cash, so you can't afford to refresh your inventory. Your existing inventory gets old and devalues. This triggers what's called an out-of-borrowing-based default, which is just a fancy way of saying the collateral securing your loan has dropped below the required limit, and the bank is demanding immediate repayment. If you can't pay, this single mismatch could force your business into a Chapter 11 reorganization, where a court literally steps in to restructure your debts, or even worse, a Chapter 7 bankruptcy, resulting in a total liquidation of your company's assets, all because you used the wrong type of loan. Finally, Section 6. Choosing the right tool. Building a sustainable capital structure. As we wrap up, remember that choosing the right loan isn't about chasing the fastest approval, and it's not even just about looking for the lowest interest rate. It is entirely about matching your business timeline. You really have to ask yourself, how long will it actually take to turn this borrowed money back into profit? If it's a matter of weeks, use working capital. If it's a matter of years, negotiate a term loan. I want to leave you with this golden rule, and it's so important. Never borrow long to solve a short problem, or short to fund a long one. Take a hard look at your own business today. Does your current capital structure match the actual lifespan of your business problems? Getting this right doesn't just save you on interest, it ensures your business has the breathing room to actually survive and thrive. Thanks so much for joining me on this explainer, and I highly encourage you to go review your own balance sheets and cash flows with these tools in mind. See you next time.